Welcome. Welcome to the Deep Dive. Today we're embarking on a truly crucial mission, one that will take us deep into the very bedrock of the U.S. mortgage industry.
That's right.
For you, our dedicated listener, we know your goal isn't just to absorb a list of dates and facts, but to master the history of this dynamic field. Our mission, to help you profoundly understand the why and how behind every regulation, every act, every government body, so you can walk into that safe exam with not just confidence, but with a perfect score.
That's precisely it. We're going far beyond simple memorization. Think of this as a journey where we trace the chronological development of the key acts, the essential government bodies, and the pivotal regulations that have meticulously built the modern mortgage landscape.
We're essentially peeling back the layers.
Exactly. Peeling back the layers of time to reveal the foundational principles that govern, well, everything you do today as a mortgage loan originator.
And as our sources vividly illustrate, the history of the U.S. mortgage industry is fundamentally one of what's often called cyclical reform.
Right, cyclical reform. That's a great way to put it.
It's not just a straight line of progress. It's a continuous, often reactive effort to balance three core pillars: market stability, robust consumer protection,
Crucial.
and crucially, fair access to housing finance for all. Each new law, each new agency has emerged in direct response to specific economic crises, to new technological advancements, or, to evolving social and ethical demands.
You're absolutely right. It's this interconnectedness, this cause and effect relationship between challenges and legislative responses that truly provides the aha moments.
Exactly. Those aha moments are what make it stick for the exam.
For sure. We'll see how a problem in one decade directly led to a solution in the next, often paving the way for unforeseen issues that then required further reform.
It really is a testament to the industry's constant evolution, isn't it?
It really is.
So we'll see that dynamic play out as we journey through the decades. Let's unpack this and dive deep into the fascinating, ever-unfolding story of how the mortgage industry came to be what it is today and why those regulations you're citing are so vital.
Okay, so our deep dive truly begins in the mid-20th century, specifically the transformative period from the 1940s through the 1960s.
The post-war era.
Right. This post-war era wasn't just about economic recovery. It marked a pivotal time when the federal government first began making serious, systematized efforts to structure housing finance across the entire nation.
Making it more uniform.
Precisely. It's when the very first pillars of consumer rights in the U.S. began to be firmly established within this burgeoning sector. Before this, housing finance was much more localized and, frankly, less regulated, leaving many without access.
Kicking us off in 1949, we encounter the creation of the Rural Housing Service, or RHS. Now, this wasn't some standalone agency that just popped up out of nowhere.
No, it had context.
Right. It was thoughtfully established through the broader Housing Act of 1949 and operates as a vital program of the U.S. Department of Agriculture, the USDA. It's important to understand that connection.
Absolutely.
Its purpose, even back then, was incredibly specific and vital: to assist low-income borrowers purchase homes in rural areas.
Which was huge.
Yeah, this was a truly significant step towards expanding homeownership beyond the more established urban centers, reaching communities that were often overlooked by traditional lenders.
And the mechanism through which the RHS achieved and continues to achieve, this is quite ingenious. It primarily uses what are known as Section 502 loans.
Section 502.
Got it. These loans can take one of two crucial forms. First, there are direct government-funded loans, where the government itself provides the capital directly to the borrower.
Direct lending.
Right. This is vital in areas where private capital simply isn't available. Second, and perhaps even more impactful for expanding reach, are privately funded loans that are guaranteed by the RHS.
The guarantee mechanism.
Exactly. This duality showcases an early, deliberate federal role, not just in direct lending, but more importantly, in underwriting risk.
De-risking it for private banks.
Precisely. By guaranteeing these loans, the RHS essentially told private lenders, if this borrower defaults, we've got your back. This dramatically reduced the risk for banks, encouraging them to extend credit to otherwise unbankable rural properties and borrowers.
That makes sense.
It truly set a powerful precedent for how government involvement could effectively leverage private capital to expand access to homeownership in underserved areas.
That's a fascinating insight into how government programs can, incentivize private lending. Now fast forward to 1968,
Wow, 1968. What a year.
a year that truly stands out as landmark in so many ways, and we see the establishment of the Department of Housing and Urban Development, or HUD.
But
This
yeah.
wasn't just another agency, it was formed as a cabinet-level office, which signified its immense national importance and the recognition that housing was a national issue.
Big deal.
Its overarching mission is incredibly broad and impactful, aiming to create strong, sustainable, inclusive communities and quality, affordable homes for all.
That's a powerful, almost aspirational statement of intent that continues to guide its work today.
Indeed, HUD serves as the singular primary federal agency for national housing policy. Its key role is to coordinate and implement housing strategies across the entire country,
Centralizing thing.
moving beyond the piecemeal approaches that existed before. And critically, for anyone in the mortgage industry, it oversees some other absolutely crucial entities within the housing finance landscape.
Like the FHA.
Exactly.
Yeah.
It has direct oversight of the Federal Housing Administration, the FHA, whose loan programs you, as an MLO, will encounter constantly.
Time.
It also oversees the Government National Mortgage Association, Ginnie Mae.
Ginnie Mae. Vital for the secondary market.
Right, which plays a vital role in the secondary mortgage market by guaranteeing mortgage-backed securities. This highlights HUD's central coordinating role, bringing many disparate federal housing initiatives under one powerful, unified umbrella.
It sounds like 1968 was a year of profound restructuring and vision.
It really was. And in that same transformative year, Congress made it clear that while everyone should have a home, how you acquire that home should be fair for everyone, regardless of who you are.
Which leads us to
Another truly monumental piece of legislation, the Fair Housing Act.
so important.
This act, fittingly, is enforced by HUD itself, the very agency tasked with creating equitable housing opportunities. Congress adopted it with three very clear, very powerful primary goals.
Okay, what were they?
First, and quite simply, to provide fair housing throughout the United States. Second, to prohibit discrimination in the sale and renting of housing.
Makes sense.
And third, which is incredibly crucial for MLOs,
Yeah.
to prohibit discrimination in mortgage lending transactions.
Directly relevant.
Absolutely. This act laid down a foundational anti-discrimination principle directly within the housing and lending spheres, a principle that, before 1968, was shockingly absent in many areas, particularly with practices like redlining,
Yeah, redlining was terrible.
effectively segregating communities.
And to effectively achieve those ambitious goals, the Fair Housing Act explicitly lists the protected classes, making it unequivocally illegal to discriminate based on race, color, religion, sex, national origin, disability, and familial status.
A comprehensive list.
Its impact was and continues to be foundational, marking an undeniable pivot towards ensuring equitable access to housing and credit for all Americans.
So for you, the listener, understanding the Fair Housing Act isn't just about passing an exam.
No, it's fundamental practice.
It's non-negotiable for your daily practice.
Yeah.
It underpins your ethical and legal obligations to treat all applicants fairly and without bias, directly addressing historical injustices and ensuring social justice within the housing market.
It's about ensuring every person has an equal shot at the American dream of homeownership.
And truly, what a year 1968 was.
Yeah.
Not only HUD and the Fair Housing Act, but also the Truth in Lending Act, or TILA.
TILA, another big one, Regulation Z.
Right, TILA. This one was enacted as Title I of the broader Consumer Credit Protection Act. Now, its initial goal was quite specific, but incredibly revolutionary for its time, informing consumers about the cost of credit.
Which seems basic now, but wasn't then.
Exactly. Can you imagine trying to get a loan before TILA? Consumers often had no clear, standardized way to compare the true total cost of different loans. Lenders could obscure fees and interest rates,
Made comparison shopping impossible.
making it nearly impossible to make informed decisions.
That's absolutely right. TILA was implemented through what's known as Regulation Z, a name you will encounter repeatedly as an MLO.
Red Z, yes.
While it was initially enforced by a variety of agencies, today its primary enforcement lies with the Consumer Financial Protection Bureau, the CFPB,
The CFPB again.
which we'll definitely delve into later. What's particularly fascinating about TILA is how its scope has expanded significantly over the years.
It wasn't just about cost.
It started with simple cost disclosure, ensuring consumers understood the annual percentage rate, or APR, and the total finance charge. But it now addresses a much broader range of issues, including deceptive advertising practices, predatory lending,
Predatory lending, a huge issue later on.
and the origination of loans without considering a borrower's repayment ability. This expansion was a direct response to new market practices that emerged to, well, circumvent the original intent.
And it's this expansion that makes TILA critically relevant for an MLO, because it mandates those essential, clear disclosures that give consumers transparent, upfront information about loan terms and costs.
Transparency is key.
Knowing Regulation Z inside and out, understanding concepts like the APR and finance charges, is fundamental to ethical and compliant lending. It's about empowering the borrower to truly understand what they're signing up for
Before they commit.
to one of the biggest financial decisions of their lives. It's the cornerstone of consumer transparency in lending.
Okay, so moving into the 1970s, we witness a distinct evolution in federal oversight and consumer protection.
Building on the 60s momentum.
Exactly. This decade really built on the momentum established in the late 1960s, introducing a wave of legislation that went even deeper into ensuring fairness in various aspects of financial transactions.
Like what specifically?
We're talking about regulating credit reporting, standardizing settlement services, ensuring equitable lending decisions, and importantly, introducing new tools to combat financial crime as the financial system became more complex.
And at the top of that list in 1970, we have the Fair Credit Reporting Act, or FCRA.
FCRA, Regulation V.
Right, FCRA. This act, implemented through Regulation V, was Congress's clear intent to ensure the accuracy, fairness, and privacy of consumers' personal information that is assembled and used by consumer reporting agencies.
Before this, credit reporting was kind of the Wild West, wasn't it?
It really was. Errors were common, and consumers had little recourse or visibility into the information that heavily influenced their ability to get a loan or even a job.
Yeah, that's a scary thought. The enforcement of FCRA is a shared responsibility, falling to both the CFPB and the Federal Trade Commission, or FTC.
CFPB and FTC.
Okay.
For an MLO, understanding FCRA is absolutely crucial because you constantly work with credit reports.
Daily basis.
Right. This act dictates how those reports are generated, how they can be used, and perhaps most importantly, it protects consumer rights regarding their own credit information, including the right to dispute inaccurate information.
Giving consumers agency.
Precisely. It ensures that the very data you rely on to assess a borrower is accurate, handled with privacy, and that the consumer has agency over their financial reputation. You'll be the one helping explain credit report nuances to your clients, so FCRA is foundational.
Then, still in 1970, we encounter the Bank Secrecy Act, or BSA.
BSA, yeah. Also known as the Currency and Foreign Transactions Reporting Act.
Right. This act had a very specific, almost prescient design for its time. It was designed to prevent the U.S. financial services industry from being used to launder money.
A big step against illicit finance. It really was. A significant and groundbreaking step towards identifying and preventing illicit financial flows within the legitimate banking system at a time when organized crime was becoming increasingly sophisticated in its financial operations.
This act is primarily enforced by the Financial Crimes Enforcement Network, or FinCEN.
FinCEN, part of Treasury.
That's right, a key agency within the Department of Treasury. The BSA requires financial institutions, including mortgage lenders, to actively aid the government in detecting financial crimes, primarily through reporting large cash transactions and suspicious activities.
Suspicious activity reports, SARS.
Exactly, SARS. What's fascinating here is that the BSA introduced some of the very first comprehensive anti-money laundering, or AML, measures in the U.S. It laid fundamental groundwork for future anti-fraud efforts, especially as financial crimes became more sophisticated and globalized.
So even as an MLO, you're part of that bigger picture.
Definitely. For an MLO, understanding the spirit of BSA is about recognizing your role in safeguarding the financial system from abuse, even if you're not directly filing a SAR yourself.
Okay, so the FCRA tackled the accuracy and privacy of your personal financial story, while the Bank Secrecy Act, passed that same year, began to tackle the integrity of the financial system itself, aiming to stop the flow of illicit money.
Good summary.
Now, fast forward a few years to 1974, and we get the Real Estate Settlement Procedures Act, RSPA.
RSPA, Regulation X.
Regulation X, yes. This act, implemented via Regulation X and enforced by the CFPB today, was passed with a very specific consumer-centric purpose. It was intended to curb the unethical practice of charging consumers unearned fees for settlement services.
Those infamous junk fees at closing.
Exactly.
Yeah.
Can you imagine a time when you're at the closing table, after weeks of paperwork, exhausted and excited, and suddenly a dozen new cryptic fees appear out of nowhere?
Fees for services you never got or understood.
Right, some for services you never understood, or worse, never received. That was the reality for many consumers, leading to the public outcry that demanded RESPA.
RESPA is specifically applicable to federally related mortgage loans, which in today's market covers a vast majority of the mortgages you'll encounter as an MLO.
Most loans, basically.
Pretty much. It has several absolutely crucial provisions. It requires specific disclosures about settlement costs, ensuring consumers know what they're paying for up front and can compare.
Like the loan estimate and closing disclosure precursors.
Sort of the groundwork for them, yes. But crucially, it also prohibits problematic practices like kickbacks,
No kickbacks.
which are referral fees for services not actually performed, and unearned fees. So for an MLO, understanding RESPA is not just vital for compliance, it's about ensuring transparency and fairness.
It affects how you handle closing.
It directly impacts how you handle closing costs and protects consumers from hidden, surprising charges. Your role is to guide them through these disclosures, making sure they truly understand every line item.
And yet another vital piece of legislation from 1974 is the Equal Credit Opportunity Act, or ECOA.
ECOA, Regulation B.
Regulation B. This act was enacted with one overarching purpose: to eliminate discriminatory treatment of credit applicants.
Brought into the scope beyond just housing.
Exactly. It really broadened the scope of anti-discrimination beyond just housing access to the very process of applying for credit itself. Before ECOA, it was not uncommon for lenders to deny credit based on assumptions or prejudices related to a person's gender, marital status, or even their race,
Leaving qualified people out.
often leaving qualified applicants without options.
ECOA is enforced by the CFPB through Regulation B, and its prohibitions are crystal clear and legally binding. It outlaws the unethical practice of discriminating against loan applicants based on personal characteristics, such as gender, race, national origin, and marital status.
Builds on fair housing.
It's a critical and necessary expansion of the anti-discrimination principles we first saw in the Fair Housing Act, but now specifically applied to the credit application process as a whole. It reinforces the core principle of fair access to financing,
Absolutely critical.
unequivocally stating that personal characteristics unrelated to creditworthiness simply cannot be used to deny someone a loan. For MLOs, this means every application must be evaluated based on objective financial criteria, ensuring equity and upholding the spirit of fair lending.
Okay, so as we move into the late 20th century, the 80s and 90s.
Right, a new set of challenges.
This era marks a period where legislation really started responding to significant economic crises, specifically the savings and loan crisis,
S&L crisis, yeah, that was huge.
and simultaneously addressing emerging forms of predatory lending and, importantly, unnecessary consumer costs that had come to light. The industry was evolving rapidly, and new vulnerabilities were being exposed.
A prime example of this reactive yet essential legislation is the Financial Institutions Reform, Recovery, and Enforcement Act, or FREA, passed in 1989.
FREA.
This act was a direct, critical response to the catastrophic savings and loan crisis of the 1980s, which had been, in large part, fueled by faulty and inflated property valuations.
Bad appraisals.
Exactly, bad appraisals. This crisis exposed a huge vulnerability in the financial system. If the collateral for loans the property itself was incorrectly valued, the entire system could crumble. FREA stepped in forcefully to fix this glaring problem.
And one of FREA's most significant and lasting establishments was the creation of the Uniform Standards of Professional Appraisal Practice, or USPAP.
USPAP, yes. Still the standard today.
FREA didn't just suggest, it established the Uniform Standards of Professional Appraisal Practice, USPAP, as the generally accepted appraisal standards in the United States. This was truly monumental.
Standardizing the whole process.
It meant that for any federal loan transaction, compliance with USPAP is now mandatory for appraisers. It professionalized an entire segment of the industry that was previously prone to subjective, sometimes fraudulent, valuations.
The impact of FREA on the industry, and especially for MLOs, cannot be overstated. By standardizing and professionalizing the appraisal process through USPAP,
It brought stability.
it directly addressed a systemic weakness that contributed heavily to a national financial crisis. It's crucial for loan integrity because accurate, unbiased property valuations are the absolute bedrock of secure lending.
You need to trust that valuation.
Absolutely. You, as an MLO, need to know that the collateral for your loan is valued correctly and independently. USPAP helps ensure that, providing confidence that the loan-to-value ratio is based on a sound, standardized assessment.
Then in 1994, as the subprime mortgage market began its significant and somewhat unchecked growth,
The subprime boom begins.
we saw the passage of the Homeownership and Equity Protection Act, or HEUPA.
HOPA Section 32 loans.
Right. This act was a direct and critical response to the rise of predatory lending practices that were starting to exploit vulnerabilities in that burgeoning subprime sector.
Things like equity stripping.
Exactly. Before HEPA, lenders could easily craft loans with exorbitant fees, high interest rates, and dangerous features like balloon payments that trapped borrowers in a cycle of debt.
HEPA was actually an amendment to TILA,
Building on TILA again.
demonstrating how existing legislation can be adapted to new challenges and abuses. Its core purpose is to directly address those very predatory lending practices by prohibiting particular acts and practices that were formerly associated with transactions for subprime loans.
Targeting the bad actors.
Yes, this wasn't just a Band-Aid. It was the first strong federal acknowledgement that the subprime label was being weaponized, used to strip equity and trap vulnerable borrowers in toxic loans.
So how did it work?
HOEPA does this by specifically defining what constitutes a high-cost mortgage based on APR or points and fees thresholds.
Section 32 trigger points.
Right. Allowing for enhanced, stricter protections for these riskier loan types, including mandatory counseling and limitations on certain loan terms like prepayment penalties.
Gotcha. Enforced by.
Enforced by the CFPB today. HOEPA was a vital early federal intervention to protect consumers from abusive practices that were becoming increasingly common in the subprime market, profoundly shaping the ethical boundaries of lending.
And as the decade closed out in 1998, we got the Homeowners Protection Act, or HPA.
The PMI Act.
The PMI Act, yeah. This law addressed a very specific and, frankly, irritating problem for homeowners: continuing to pay for private mortgage insurance, or PMI.
Even when it wasn't needed anymore.
Even after they'd built up significant equity in their homes. It was money out of their pockets for a protection that arguably they no longer needed. And before HPA, it was difficult to cancel.
That's right. Congress passed the HPA to facilitate the cancellation of PMI, providing a clear, legally mandated pathway for homeowners to stop those unnecessary payments once they reach specific equity thresholds.
What were those thresholds?
Typically 80% loan-to-value based on the original value, or potentially earlier if the home value increased, and automatic termination at 78% LTV.
Automatic at 78%, that's key.
Yes. This law is enforced by the CFPB, along with other federal bank regulatory agencies. For consumers, the HPA was a direct and tangible benefit, offering that mechanism to stop paying premiums.
Saving homeowners money.
Exactly. For MLOs, understanding these cancellation rules is incredibly important, as you'll frequently encounter questions about PMI from your borrowers and need to accurately explain their rights and the process under this act. It empowers you to give correct, valuable information.
Okay, stepping into the new millennium, the 2000s.
A new century, new challenges.
This decade kicked off with laws designed to adapt to the burgeoning digital age, recognizing that commerce was rapidly moving online.
The dot-com era influence.
Right. But as we all know, it culminated in a catastrophic financial crisis that would permanently, fundamentally reshape the entire mortgage industry and usher in an entirely new regulatory paradigm.
The calm before the storm, then the storm itself. Kicking off the decade in 2000, we have the Electronic Signatures in Global and National Commerce Act, commonly known as the e-Sign Act.
E-Sign, making digital legit.
Pretty much. With the internet booming and businesses eager to conduct transactions digitally, this act was crucial for facilitating commerce in the rapidly expanding digital era. Its general goal is to address the validity of documents, records, and signatures that are in electronic form, ensuring that an electronic signature carries the same legal weight as a wet ink signature on paper.
The impact of the e-Sign Act was profound and foundational for nearly every industry, including mortgages. It essentially legalized electronic transactions,
Game changer.
giving e-signatures and electronic documents the same legal weight as their paper counterparts. For the mortgage industry, this was a fundamental, game-changing shift, enabling the digital processing and signing of loan documents, which streamlines the entire process significantly.
Think about loan applications today.
Exactly. Think about how much of your work relies on digital documents today, from applications to disclosures. This act made it all legally possible and paved the way for faster, more efficient transactions. It allowed the industry to modernize.
Then, swiftly enacted after the tragic events of September 11, 2001, we saw the USA Patriot Act.
A reaction to 9/11.
A direct reaction. Its immediate purpose was to strengthen the provisions put into place by the Money Laundering Control Act of 1986. with the overarching goal to combat terrorist financing.
Tightening financial security.
Significantly. It represented a significant, urgent tightening of financial security measures, recognizing that illicit funds could flow through legitimate channels.
And it did this by amending the Bank Secrecy Act,
Building on BSA.
requiring much more robust anti-money laundering programs from financial institutions, including mortgage companies, primarily enforced by FinCEN.
FinCEN again.
The Patriot Act dramatically increased scrutiny on financial transactions. For lenders and MLOs, this meant a significant uptick in compliance requirements, focusing on stringent customer identification programs, CIPs.
Know your customer rules.
Right, CIPs and suspicious activity reporting, SARs, to prevent illicit funds from entering the financial system and financing terrorism. It was a game changer for financial security and added a significant layer of due diligence to every transaction.
In 2003, as an important amendment to the FCRA.
Another FCRA amendment.
Yes, Congress passed the Fair and Accurate Credit Transactions Act, or FACT Act, FACTA.
FACTA, okay. What did this one do?
This act was specifically designed to combat the growing and alarming threat of identity theft, which was becoming a major problem as more information moved online.
Identity theft protection.
Exactly. Its objectives were clearly stated: to address the problem of identity theft, to facilitate consumers' access to the information retained by CRA's consumer reporting agencies, and to improve the accuracy of consumer reports. It gave consumers more power over their credit information.
Like getting free credit reports.
That was a big part of it, yes. The right to a free annual credit report from each major bureau. But a really significant and practical outcome of the FACT Act was that it directly led to the creation of the FTC Red Flags Rule.
The Red Flags Rule. What's that?
This rule requires creditors, including mortgage lenders, to develop and implement comprehensive identity theft prevention programs. These programs mandate financial institutions to identify, detect, and respond to patterns, practices, or specific activities known as red flags
Warning sign.
that indicate possible identity theft. For MLOs, this is incredibly relevant to your daily work. You need to be vigilant. It connects to ongoing efforts to protect consumer data and ensuring the accuracy and integrity of credit reports, which are central to the lending process.
So it's about spotting potential ID theft during the application process.
Exactly. It's all about safeguarding borrower information and maintaining the security of financial transactions.
Then came 2008,
The year everything changed.
a year that saw the full, devastating impact of the subprime mortgage crisis unfold, leading to a global financial meltdown. In direct response to this unprecedented crisis, Congress enacted the Housing and Economic Recovery Act of 2008, or HARA.
ARA, a huge response.
Yes, this was a comprehensive piece of legislation with multiple ambitious goals, which crucially included establishing a nationwide licensing database and education standards for the mortgage industry.
Addressing the lack of oversight.
Clearly, this indicates a clear recognition that part of the crisis stemmed from a glaring lack of oversight and consistency in how mortgage professionals were licensed and regulated across different states. It was truly the Wild West in some areas.
And HRA did something else critically important that is often overlooked in the shadow of the SAFE Act. It created the Federal Housing Finance Agency, or FHFA, specifically to oversee Fannie Mae and Freddie Mac. These are the government-sponsored enterprises, or GSEs, that play an absolutely massive role in the secondary mortgage market.
Huge role.
Buying and guaranteeing a huge portion of mortgages originated in the U.S. By creating the FHFA, Congress aimed to bring stronger, unified oversight to these giants after they required massive bailouts.
Okay, oversight for Fannie and Freddie. But, and here's where it gets really interesting and directly relevant for you, our listener.
The main event for MLOs.
Title V of HERA was arguably its most crucial component for your career trajectory. The Secure and Fair Enforcement for Mortgage Licensing Act, the SAFE Act.
The SAFE Act, implemented through Regulations G&H and enforced by the CFPB, is foundational to your preparation for the SAFE exam. Before SAFE, you could have a mortgage lender banned in one state, simply hop across the border and set up shop with no accountability.
Unbelievable, but true.
This act fundamentally changed that. It requires states to adopt minimum uniform licensing standards for mortgage loan originators and to participate in the nationwide multi-state licensing system, or NMLS.
The NMLS system. Every MLO knows it.
Right. This standardization was implemented specifically to enhance consumer protection by creating a national ecosystem of accountability and to reduce fraud across the mortgage industry. Your license, your history now follows you across state lines.
So for our listeners preparing for the SAFE exam, this is truly where the rubber meets the road. This act directly impacts you as an MLO preparing for the SAFE exam.
Your license depends on it.
The very existence of your licensing requirements, the NMLS system you'll use for registration and ongoing education, and the standardized education you're undergoing all stem directly from the SA-IFE Act.
Understanding why it exists is key.
Exactly. Understanding its origins in HRA and the post-crisis environment explains why these robust licensing and education standards are in place. It's not just about passing an exam. It's about being part of a regulated industry specifically designed to protect consumers and ensure integrity in lending.
Weeding out the bad apples.
Weeding out the fly-by-night operators that thrived in less regulated times.
Following closely on the heels of the crisis, in 2009, Congress passed the Fraud Enforcement and Recovery Act, or FARA.
FARA, focused on fraud.
Precisely. This law was intended to facilitate the prosecution of those who commit mortgage fraud and to increase the financial resources that are available to investigate and prosecute fraud cases.
More resources for enforcement.
Yes. In the wake of the subprime meltdown, where rampant fraud contributed significantly to the crisis, there is a clear, urgent need to bolster the fight against this illicit activity and hold perpetrators accountable.
FARA essentially gave law enforcement and prosecutors significantly more teeth to go after fraudulent actors in the mortgage space.
Stronger penalties, more tools.
It increased funding and strengthened the legal framework, making it easier to pursue and convict those who contributed to the crisis through deceitful practices. It underscored the government's unwavering commitment to holding perpetrators accountable,
Sending a message.
and reestablishing trust and integrity in a market that had been severely shaken by widespread abuse. It was a direct signal that the era of unchecked fraud was over.
And this brings us squarely into the 2010s, an era profoundly defined by one monumental piece of legislation, the Dodd-Frank Wall Street Reform and Consumer Protection Act.
Dodd-Frank, the big one.
The big one. This was a direct, sweeping response to the 2008 financial crisis, aiming to prevent a similar catastrophe from ever happening again. It truly created a new regulatory paradigm,
A whole new world.
including establishing a brand new primary regulator and, significantly, the most stringent underwriting standards the industry had ever seen, fundamentally reshaping how loans are originated.
Dodd-Frank was incredibly comprehensive, stretching over 2,000 pages, covering almost every facet of the financial system.
Massive piece of legislation.
Among its many provisions, it broadly prohibits all providers of consumer financial products and services from engaging in unfair, deceptive, or abusive acts or practices, or UDAP.
UDAP, a key concept.
This single, powerful prohibition became a cornerstone of consumer protection moving forward, providing regulators with a broad tool to tackle new forms of financial misconduct. But two specific titles within Dodd-Frank are particularly important for our discussion on mortgages.
Title X and Title 14.
Exactly. Title X of Dodd-Frank authorized the creation of the Consumer Financial Protection Bureau, the CFPB.
Finally, the CFPB officially created.
Which we've mentioned quite a few times already as the enforcer of so many key acts. And Title 14, known as the Mortgage Reform and Anti-Predatory Lending Act, applies directly and comprehensively to mortgage originators, servicers, and appraisers.
Directly aimed at the mortgage process.
Right. Dodd-Frank fundamentally reshaped financial regulation, moving from a fragmented, sometimes inadequate oversight approach to a more centralized, stringent framework aimed at preventing another financial meltdown and protecting consumers at every stage of the loan process.
And speaking of the CFPB, it officially opened its doors on July 21st, 2011 under Dodd-Frank's Title X.
The CFPB era begins.
The CFPB quickly became the single principal federal regulator for mortgage lending, effectively inheriting authority from numerous other federal agencies,
Consolidating power.
including the Federal Reserve, HUD, and FTC, consolidating consumer financial protection under one powerful umbrella. This was a game changer, centralizing consumer protection oversight, simplifying enforcement, but also undeniably increasing regulatory scrutiny.
What are its main duties?
The CFPB's duties are broad, impactful, and directly relevant to consumers. They include conducting financial education for consumers,
Educating the public.
not just through pamphlets, but by developing interactive online tools and working with community groups to demystify complex financial products. They also collect and respond to consumer complaints,
A place to complain.
providing a direct channel for consumers to report issues. And crucially, they supervise financial entities for compliance with federal consumer financial laws, ensuring the rules are actually followed.
Supervision and enforcement.
Right. Its significance lies in that centralized authority for consumer protection, which, while simplifying oversight in some ways, also undeniably increased regulatory scrutiny across the board for all financial institutions involved in consumer lending, holding them to a higher standard.
Now, mandated directly by Dodd-Frank, we have two of the most critical rules for any MLO to understand and apply today. The ability to repay, or ATR,
ATR.
and qualified mortgage, or QM rules, which came into effect in 2014.
ATR QM,
Yeah.
absolutely essential.
These rules represent the most stringent underwriting standards in the industry's history, a direct response to the lax lending practices that fueled the crisis.
The ATR rule specifically requires creditors to make a reasonable, good faith determination of a borrower's ability to repay their loan.
Document everything. Verify income.
Exactly. This sounds obvious in hindsight, but prior to the crisis, stated income loans and no-doc loans were common. Post-crisis, ATR became a strict legal requirement demanding verification of income, assets, and debt-to-income ratios. No more liar loans.
And the QM rule.
QM rule, implemented through Regulation Z, creates a category of loans known as qualified mortgages, meaning loans that meet specific, safe criteria.
Safer loan features.
Right. These QM loans offer a safe harbor from liability under the ATR rule. This QM safe harbor is a game changer for lenders because it offers a critical legal shield.
A legal shield, how so?
Well, if a loan adheres to QM standards, meaning it avoids risky features like interest-only payments, negative amortization, or terms over 30 years, and caps points and fees, the lender is presumed to have met their ATR obligation.
Presumed compliance.
Exactly. This doesn't mean they're immune to all lawsuits, but it makes it significantly harder for a borrower to claim the lender didn't properly assess their ability to repay, bringing much-needed clarity and risk mitigation to the post-crisis lending environment.
And this is absolutely critical for your safe exam preparation and your future career. Understanding ATR and QM isn't just about memorizing definitions.
It's about the principle of safe lending.
It's about grasping the core principle of responsible lending in the post-crisis era. It's about ensuring that loans are made based on a borrower's actual verifiable ability to pay, protecting both the consumer from unaffordable debt and the stability of the housing market from reckless lending.
It underpins everything you do in qualifying.
Absolutely. These rules underpin compliant and safe lending practices, and you'll interact with their principles every single day as you qualify borrowers and structure loans.
And finally, also mandated by Dodd-Frank as part of this comprehensive reform, we have the TILA-RESPA Integrated Disclosure Rule, famously known by its acronym, TRIDE.
TRIDE. The loan estimate and closing disclosure.
That's the one. While TILA and RESPA existed before, Dodd-Frank saw an opportunity to improve the disclosure process. The rule used to implement these new combined disclosures, the loan estimate and the closing disclosure, is what we call TRIDE.
Implemented by the CFPB, TRIDE purpose was elegant in its simplicity. It combined 4 previous, often confusing, federal disclosures
Simplifying things for the borrower.
into 2 much more simplified, consumer-friendly forms. The goal, to help consumers truly understand their loan terms and costs more clearly, upfront with the loan estimate, and then again at closing with the closing disclosure.
Allowing for easy comparison.
Allowing for easy comparison and preventing last-minute surprises. For an MLO, TriRD has a direct, practical impact on your daily workflow.
Strict timing rules, too.
Very strict. It's absolutely central to ensuring consumer transparency from application to closing, requiring strict adherence to disclosure timelines and content, making sure the borrower is truly informed every step of the way.
So, wow, we've covered a remarkable journey today.
A lot of grand.
Moving from the foundational acts of the mid-20th century that began to systematize housing finance and establish basic consumer rights, all the way through to the comprehensive reforms of the post-crisis era.
Seeing that cycle of reform.
We've seen how each legislative wave was a direct response to specific challenges or economic shifts, clearly confirming that cyclical nature of reform are sources highlighted at the outset. It's a story of constant adaptation.
Absolutely. And as you prepare for that SAFE exam,
Mm-hmm.
remember that understanding this timeline isn't just about rote memorization of dates and acronyms.
It's about the why.
It's about grasping the interconnected narrative, the why these regulations exist, and how they evolved in response to real-world problems and crises. It's these aha moments, understanding the problem that each law was designed to solve, that make the rules stick and truly enable deeper application, not just recall.
Makes perfect sense.
Throughout this history, you can clearly see the consistent threads that weave through every act and every agency we discussed. Balancing market stability, ensuring robust consumer protection, and promoting fair access to housing finance. These are the core tenets that continue to shape your profession.
So, as we conclude, consider this. If history consistently shows us that regulations emerge in response to new economic realities, crises, or technological shifts, what do you think might be the next major area of focus for mortgage industry regulation?
Interesting question.
Think about how emerging technologies, perhaps artificial intelligence and its role in underwriting, or even the rise of digital currencies,
AI underwriting is a big topic now.
or changing demographics and evolving housing needs, might shape the next wave of reforms. It's a dynamic industry, and the story continues to unfold, making your understanding of its history even more crucial for its future.
Thanks for joining us on this deep dive. Go ace that exam.